Hello and welcome to the next of our full course lectures. This lecture is looking at inventory. Don't forget you can download all of our mind maps shown here for free on our website www.mapitaccountancy.com. So really what we're doing over the next few lectures is looking in detail at various areas of the financial statements to see how they can be treated, to see how we record them in our ledgers. So it's important that we know enough about each of those areas to be able to deal with them in the exam. So the first area that we're looking at is inventory. Remember, inventory really is stock. Okay, so one of the key aspects to our inventory is what value should we have it at in our financial statements. So valuation is a really important area of our inventory. And we need to learn that the valuation, and this is under IAS 2 in our IFRS standards, is that it is at the lower of cost and net realizable value. So inventory should be valued at the lower of cost and net realizable value. So in order for us to know which of those it's going to be, we need to know what is the cost and what is the net realizable value. And both of those involve some calculations or some areas of discrepancy that we need to deal with, because not all costs will go in and we need to understand what net realizable value is. So let's start with cost. Broadly speaking, for cost, we're looking at the amount to bring the items to their present location and their present condition. So that's what the standard says. It says that we have in the cost of the item any costs in bringing the item to its present location and its present condition. So what does that include? Well, it will include, of course, the cost of purchase. Now within that cost of purchase, you'll have the price, but you'll also be able to include any duties on that price. So maybe import duties of bringing it into this country. Also, we can have transport costs into the company, but not out to get it sold. So costs of purchase includes price, duties, and transport, and includes handling of the goods. So obviously, we'll maybe have them brought into the warehouse and then brought out of the warehouse. That's handling, and that is included in the cost of purchase. Also included in the cost of the goods is the cost of conversion. The cost of conversion will include direct labour and direct overheads. Remember, it's in bringing the item to its present location and its present condition. So its condition will include expenses that we have had in converting it. So labour and overheads will be included, and those have to be direct costs. Costs that we can directly attribute to that unit of production. Now, it's almost as important to learn the things that are not included in the cost. So costs that we can't add in here. We cannot bring in abnormal waste. So abnormal waste will not be included as a cost. That means that during the conversion process, we can include normal wastage that we expected. But if there's any wastage over and above that, abnormal waste, we can't include that in the cost of the unit. We also can't include storage costs. So whilst we could bring in the cost of moving the goods into the warehouse, we cannot include the cost of actually warehousing the goods. So those storage costs cannot be included. We also can't include indirect admin costs. Well, we know that because, as I said, we can only include direct costs, direct overheads. Well, indirect overheads would not be included, and that would include admin costs. Also not included will be selling costs. So we can't add on the selling costs in calculating the cost of our unit. So that's what we need for our cost. Remember, we're looking for the lower of cost and net realizable value. We now know that cost is the amount to bring the item to its present location and its present condition. Includes the price, duties, transport and handling, and any direct costs of conversion, but doesn't include abnormal waste, storage costs, indirect costs, and selling costs. Now, we said we're going to compare the two, cost and net realizable value. So how do we calculate the net realizable value? The net realizable value I want you to think of as the amount that we will get for the product. So the net realizable value will be the selling price. The only thing we'll take out of it will be the costs to complete and the selling costs. So we say, right, how much do we think we're going to sell this unit for? Less any costs that we still have to complete it and any selling costs that we will incur. So whereas the cost of the item that we're comparing to the net realizable value is based on adding up all of the costs, the net realizable value is worked out by working back from the sales price. So taking the sales price and subtracting out any costs we expect to complete the item and any selling costs. Once we've calculated the cost of the product and the net realizable value, we compare the two and we bring it in at the lower of those two. So the rule is we have it at the lower of cost and net realizable value. If the inventory was in at a price or a valuation that was higher than what we found it should be, well then some of that inventory may well need to be written off. We may have to write it down to its cost or net realizable value, whichever is the lowest. So let's now have a look at illustration 1 to see how this could come up. So we're going to look at various items. There's nothing too complicated about this, so what you should perhaps do is pause the video now and then work through this question yourself before going through the answer with me. We're looking here at illustration 1. And we have various items, 1, 2 and 3 that ABC company has in inventory. So we need to decide what value each of these should be included in the inventory at. So remember, it's the lower of cost and net realizable value. So for part 1, the goods that we have for resale at a cost of 40,000, well, what we need to do for each of these is compare the cost to the net realizable value. Well, we can see that the cost is 40,000. The net realizable value, well, remember that is the selling price less the cost to complete and selling costs. So the selling price is 42,000 with costs to sell of 2,500. So that means that the net realizable value is 39,500. So we need the lower of those. The lower one is the 39,500. So if the goods are in there at cost at the minute, well then we'll need to reduce it by 500, and that would be written off to the income statement. So it would be credit inventory 500, debit the income statement with the inventory write-off. So that's the number 1. We have the goods at 40,000. In part 2, materials purchased at a cost of 30,000 per tonne, which will be sold at a profit. Now, really we don't need to go any further than that, because even though they say that the manufacturer has just announced from now on they'll sell them to us at 28,000, that doesn't matter. We need to compare the cost to the net realizable value. The cost was 30,000 and we're told they'll be sold at a profit, so they'll be sold at more than cost. So we'll simply use the 30,000. So the fact that the manufacturer has changed the price is irrelevant for the future. The costs will be sold at a profit, or the goods will be sold at a profit and thus will be valued at their cost, the 30,000 per tonne. For item 3, we have a piece of plant constructed at a cost of 50,000. It's going to be sold at 60,000 but needs to be modified at a cost to us of 4,000. So again, we're looking to compare the cost, and the cost was 50,000, to the net realizable value, which is the 60,000 less the 4,000 that we need to spend on it to finish it. The lower is 50,000, therefore we will use the cost. So if the inventory is in there at 50,000, it will remain at 50,000. So for any of these, basically you need to know how to calculate that cost using the information that you're given in the question, and then calculate the net realizable value to compare the two and see which is lower. Do look out for questions like part 2 there, where they try to confuse you by saying that they'll sell them later at a different price, or that they'll sell the goods to you later at a different price. That doesn't matter. Doesn't matter that we can buy them later at a lower price. All that matters to us is comparing the cost to the net realizable value. So now we know the rule for valuing our inventory. Let's look at the record keeping, because this will affect that valuation. So when it comes to actually getting a valuation for our inventory, well, what we will do is we will value it at the end of each year usually, and that will be through an inventory count. That inventory count is carried out on the final day of each accounting year. So on the year end, we go in and we physically count all of the inventory that we have within the business. So what we'll do during that is to compare the cost to the net realizable value, because some of the inventory might be damaged, so we might think we can't sell it for what we thought we could, or it may be obsolete, i.e. it can't be sold anymore because fashion has changed, for example. So there's a valuation done at the end of each year through an inventory count, and we compare at that stage the cost to net realizable value. Now, it could be that you carry out continuous records or a continuous inventory system, and that's where we don't just count it at the year end. So do know the difference between these two systems. Usually our ordinary inventory system has an inventory count at each year end, and we don't count it any other time. In a continuous inventory system, we keep it up to date and we count it more regularly. So it should provide us better information, and it should be more efficient. That also should mean that it's easier to get the year-end inventory figure which we require. So the theory is that rather than counting all of the inventory at the year end, it's continuously counted maybe in 12 sections, one section counted at the end of each month. Thereby you've counted all of the inventory throughout the year. And also your inventory is updated, it's linked in with your accounting system, so that on a continuous basis that inventory is constantly updated. However, there can be some downsides to continuous inventory systems. For example, the time and cost of implementing the system. So it will cost money to actually get the system in there. It'll probably be quite a complex computer system, and it will take time to train staff and to get used to using the system. Also, the inventory still needs counted. It may be counted more regularly, but it's still counted. All of the inventory must be counted at some stage over the course of the accounting period. It's just rather than counting it all at the end, you're counting it in sections over the year. So do be aware of the difference between a normal inventory system where we simply count it at the year end, and a continuous inventory system where it's linked into our accounting system and we count it on a more regular basis. Now, when it comes to our cost, so we know all of the costs that we have included in our cost valuation. However, there are some different ways that we can get the price of the goods, or that we can bring the price of the goods in, because if you think about it, we may have lots and lots of different items of inventory that we bought on different dates. Maybe they're identical items of inventory. Maybe we buy widgets and every widget is the same as the next widget. But some of those widgets were bought at the start of the year, some of the widgets were bought mid-year, and they were bought at different prices. So what price do we bring them in at? The price at the start, or the middle, or the average? Well, that's what we're looking at here, and there are some options for us. We could bring it in at the unit cost. Now, this wouldn't apply to our widgets because this is just bringing it in at the actual cost, and this is used for high value items. Let's say, for an example, you are a house builder. You build houses and sell them. Well, those are high value items. We would bring each of those houses in at their actual cost, their actual amount. So we can distinguish what it cost for each of those houses because they're high value and they're distinguishable. So for a large high value item like that, we'll bring it in at its actual cost because we can easily work that out. But for items such as widgets, I've made that up, but for something small that you can't tell the difference between one and another, well, we have two options. We can either bring it in at FIFO, and that is first in, first out. So that means that we assume that the first widgets we bought were the first ones we then sold. So first in, first out. So first received are the first sold, and we run our inventory system like that. So any sales that are made, we're assuming that the very first items that we bought in were sold first. So those will be removed from inventory. Or we can bring it in at AVCO. Now what this means is we calculate the average cost of the inventory. So we have to keep track of what price we bought them in, keep track of an average cost for all of the widgets that we've bought over the time period. And we do that either periodically or continuous over the term. So this will make a difference. FIFO and AVCO will give us different valuations for our inventory because if we are selling the first items first, we're removing those items that cost one price from our inventory. Whereas if we're using the average cost, well, we're bringing items out at a different cost. So let's look at this and see what the impact is because it makes more sense when we work through an example. If you want to, have a go yourself at this illustration if you get it. If you're not quite sure yet, then simply work through this with me, and by the end of this illustration you'll understand what the difference between these two systems is and what the importance is of actually using it. So the importance it will have on our profit, for example. So let's look at illustration 2 and work through this. In illustration 2, we have two parts, A and B. We need to calculate the closing inventory using FIFO and AVCO and see which of these solutions is correct. So that's very similar to the multiple choice we'll look at in the exam. So what we'll need to do is keep track of the inventory, what's been bought and what's been sold. We then need to value it on the first in, first out basis, and then we'll value it on the average cost basis. So first of all, let's look at what's happened with the inventory. So Jane has started the business on the 1st of June. So she's bought 10 units at $10. Then she's purchased 13 units at $11. And lastly, she's purchased 20 units at $9. In total, 20 units are sold on the 10th of June for $15 per unit. So let's work out first of all how many units she has left at the year end because we're calculating the value of the closing inventory. We need to know how many units that is. Well, she purchased 10, then 13, then 20. So in total, she purchased 43 units. She's only sold 20 of them. So there's been 20 units sold, and that means that the inventory remaining at the year end is 23. Now we need to value those 23 units firstly on a first in, first out basis, and secondly on an average cost basis. So remember, first in, first out means that the inventory we bought first of all, so we bought 10 units on the 2nd of June for $10, and we're going to assume that those were the first ones that we sold. So for FIFO, we're going to start with those 10 units. We sold all of those, so those won't have any value. Those have been sold. The units that we purchased at $11, well, we purchased 13, so that would bring our total purchases up to 23, but we sold 20. So there's only going to be 3 of those units remaining. So those 13 units on the 4th of June, we still have 3 of those in stock. We're going to value them at $11 because we're doing first in, first out. So we're assuming that those will be still there. They haven't been sold yet because they were valued at $11 each. We'll bring them in at 33. So that means that there's 3 units remaining of the ones we bought on the 4th of June, and all of the items we bought on the 8th of June will also still remain. So the items that we bought on the 8th of June of 20 items for $9 will be brought in at $180. So that means that the inventory of 23 units will be valued at $213. So we can see here that FIFO assumes that first of all, those 10 units that we bought firstly were all sold, so they don't have any value. Of the 13 units that we bought on the 4th of June for $11 each, 3 of those remain. So the 3 of those remaining will be valued at the price we bought them at, $11. And the 20 units we bought on the 8th of June all remain. We bought them at $9, so we bring them in at $9. So the 23 units are valued at $213. Now, for average valuation method, it will be slightly different. You might want to pause the video now and have a go at it. So what you'll need to do is work out the average cost of the inventory that we purchased over the term, then multiply that average cost by the amount that we still have remaining at the year end. So pause the video now, try it, and then work it through with me. So looking at the average amount, well, the total units we purchased were 43. The total cost was that we purchased 10 at $10, 13 at $11, and 20 at $9. So adding that all up, we get 423. So the 43 units in total cost us $423. The average cost per unit then was $9.84. So what we'll do is we will take the $9.84 and multiply by the amount of inventory we have remaining at the year end. So $9.84 times the 23 units gives us $226.32. So the closing stock under AVCO will be $226.32. Now, as you can see, those two inventory valuations give us a different amount, but both are equally valid under the accounting standards. The one we're not allowed to use is LIFO that you may meet in other modules. You can use that for internal management accounts, but you're not allowed to use LIFO or last in, first out for your statutory accounts, for your financial accounts. So these are the two that we will have to compare: FIFO, first in, first out, and AVCO, average stock valuation. So we're also asked then in part B, so we know the answer to part A, which is solution 3. FIFO is 213 and AVCO 226.32. We're also asked to prepare and compare the income statement under FIFO and AVCO. So we have enough information to get our revenue, and we know what the purchases and inventory at the year end were. It's a new business, so no inventory at the start of the year. So looking at FIFO first of all, well, sales were 20 units sold for $15 per unit, so that's 300. Cost of sales, no opening inventory, so simply purchases, which were all the purchases we made. Well, we already calculated that and it was 423. The closing inventory for FIFO was 213. So 213 subtracted out as our closing inventory gives us a cost of sales of 210 and a profit of 90. So gross profit 90. Now comparing that to AVCO, well, sales will be the same. So we had 300 of sales, same as we had under FIFO. Cost of sales, well, purchases will be the same, 423. However, our closing inventory was 226.32. Now I've rounded it slightly, so just call it 226. And when we subtract that out, we get our cost of sales 197. And that gives us a profit under AVCO of 103. Now that's crucially important that we note this, that simply by changing our inventory valuation method, we have changed our profit. So our profit under FIFO was 90, our profit under AVCO was 103. So that means that our profit has gone up simply by changing our inventory valuation. And that's because our closing inventory was higher under AVCO. Higher closing inventory means we're subtracting more out from our cost of sales, which means cost of sales goes down and gives us a higher profit. So you can see the impact that inventory valuation can have on profit, and it's absolutely crucial. It is an area that can be manipulated by accountants to try to increase or decrease the profit depending on what they want. So there are quite stringent rules, whereas you can't, for example, change from FIFO to AVCO very easily, or just change it depending on what you want. So once you've chosen one of these, you need to stick to it, unless there are some extenuating circumstances, because by changing your valuation, you can change your profit, and that makes it inconsistent and more difficult for users to compare. But do note here that changing that inventory valuation method will change the profit figure. So we can now move on to look at cost of sales and how this is brought into the accounts. We saw a little bit of it in the previous illustration, so we know that our cost of sales is first of all our opening inventory. So we add in our opening inventory. We do that because it is sold first. So we're assuming that opening inventory from last year is the inventory we sold first this year. Then we bring in the purchases in the year, because we'll have sold that opening inventory and we'll have sold most of the purchases that we made in the year. So we'll have sold those purchases. However, we may not have sold all of the purchases. So that's why we're subtracting out the closing inventory, because that closing inventory hasn't been sold. So that closing inventory hasn't been used to generate the sales that we have included in the income statement. So we haven't sold it yet. And that's the matching principle. So that's a very important principle in accounting. What we're doing is we're matching up the sales revenue that we've included in our income statement with the items that we sold to generate that sales revenue. That's why we subtract out the closing inventory, because we haven't sold that yet. It wasn't used in generating that income that we include in our income statement. So the revenue that was generated by selling the opening inventory and some of the purchases in the year, but not the closing inventory. So that's why we're subtracting it out. So how do we deal with all of this in our ledgers? How do we bring that inventory in? Well, the way that we're going to deal with this is that we don't keep a continuous track of our inventory within our ledger system, because that ledger system would become too convoluted if we tracked our inventory in there. So what we do is we value the inventory at the year end. So we know what the inventory was at the start of the year because we have our opening inventory. We now count it and we know what the value of the inventory is at the end of the year. And we have to think of a way to bring in that closing inventory into our accounts. So this is the method to do it. So first of all, for our opening inventory, and this is a process that you go through each time that you do this. So opening inventory, we transfer to an income statement ledger. So we're going to have a ledger for the income statement. So to bring our opening inventory in there, what we'll do is we'll debit cost of sales in our income statement and we'll credit inventory to remove it. So we credit opening inventory, all of opening inventory, whatever value it was, to remove it, and we debit our income statement. And we'll have a separate ledger account for the income statement. So we debit cost of sales in our income statement, which means that our inventory is now showing 0. So we've removed the inventory from our balance sheet effectively. So we've credited inventory to remove it. That means we've no inventory at the minute. So what we do is we bring our closing inventory in. So we value it at the year end and we bring it into the accounts now. So we value the inventory at the year end. How do we bring it in? We debit inventory because remember, inventory is an asset. So it will be a debit balance. So we debit inventory with the value of our closing inventory and we credit cost of sales in our income statement. So now we can see that inventory is showing the year-end balance. So that's how we take out the opening inventory, debit cost of sales, credit inventory to remove the opening inventory, then bring in the closing inventory by debiting inventory, crediting cost of sales, the opposite. So we do that with the value of that closing inventory. So let's just have a look in some detail at this. So we're going to look through illustration 3. This is going to show us how to deal with opening inventory and closing inventory. It's also going to start to introduce how we bring together the accounts at the year end, because as I mentioned, we're going to have an income statement ledger account, and that is going to provide the basis for our income statement for the year. So let's look at illustration 3. If you want to have a go at it, do that and then work through the answer with me. In illustration 3, we're going to deal with this inventory. We're going to show the journal entries, prepare the ledger accounts and look at gross profit. So Jane runs a business selling cushions. At the start of the year, she had 350 cushions in inventory at a cost of 5,000. So the opening inventory will be 5,000. Let's just open the ledger account for inventory first of all to bring that in. So inventory, we have the debit on the right, the credit on, or the debit on the left, the credit on the right. And we're told that the opening inventory is 5,000. So the balance brought forward, the opening inventory will be a debit balance because inventory is an asset. So the opening inventory is 5,000. Now what we need to do is deal with these transactions. So we'll do the journal entry, record it first and then post it into the ledgers. So let's record our journals. So we have the opening inventory dealt with. We have first of all to deal with a purchase of 1,000 cushions for $15,000. How will we deal with that? Well, we'll debit cash because we have used cash. So we can now look at the journal entries to deal with all of this information. We have the opening inventory in. We're going to deal with the purchases and the sales. Well, the sales are easy. We sold 950 cushions for $25 each. So let's bring those in first. We'll debit cash because we received cash for those cushions and it was $23,750. And we'll credit sales with $23,750. So debit cash, credit sales, and that's the sales in the year. We can then post those sales into our sales ledger. So let's open up a sales ledger, post them in. Now we're only asked for the gross profit in the year, so we're not going to keep a cash account. We would in real life, but we don't need it because we're not preparing a statement of financial position. So let's just deal with the sales first of all. So opening up our sales ledger, we have the debit and credits here. And then we said that in the year, we sold $25 each for 950 cushions, which was crediting cash sales 23,750. So we debited cash, credited our cash sales. So let's go back and deal with the rest of our journals. So far we've dealt with the sales. What about the purchases? We purchased 1,000 cushions in the year for $15,000. So we debit the purchases with the $15,000 and we credit cash because we received it, and that's the purchases in the year. So let's go ahead and create a purchases ledger and bring those purchases into it. So creating the purchases ledger as usual, we have our debits on the left, our credits on the right, and we said we were going to debit the cash purchases in the year 15,000. So we've posted in our 15,000. The credit will go to cash. We don't need the cash account because we're just looking for our gross profit, but the credit of course would go to cash. Now we can deal with this inventory that we have left in the year. So from our session, we learnt that we will have to remove the opening inventory and bring in the closing inventory at the year end. So first of all, we'll debit the income statement with the opening inventory of 5,000 and we'll credit inventory with 5,000 to remove that opening balance that we had on inventory. So that means we need to open a ledger account for our income statement to remove that opening inventory. We'll debit that income statement ledger and we'll credit inventory to remove it. So let's do both of those now. So we're going to create an income statement account with the debits on the left, the credits on the right. And we said that we need to debit the opening inventory to our income statement ledger. So debit opening inventory to our income statement ledger, and we credit then our inventory account also. So let's do that. In our inventory account up to this point, we simply have the balance brought forward. So now we're going to credit inventory with that opening balance of 5,000. The other side of it was to the income statement that we've just dealt with. So debit the income statement, credit inventory to remove that opening balance. The last thing we need to do is deal with the closing inventory. So we'll bring in the closing inventory of 6,000 by debiting inventory and crediting the income statement with that closing amount. So that's the closing inventory brought into the accounts. So the first step is to remove the opening inventory. The second step is to bring in the closing inventory with the opposite entries to those that we've just done. So debit inventory, credit the income statement with the amount of our closing inventory. So let's post that into our ledgers now. In our income statement up to this point, we simply have the opening inventory. We now bring in the closing inventory on the other side of 6,000. So we credit the income statement with 6,000 and the debit will go to inventory. So let's post that into our inventory account. So up to this point in our inventory account, we had our balance brought forward. We removed it by posting a credit to the income statement. We're now debiting the inventory account to bring in the closing inventory of 6,000. The other side of that was in the income statement. So we have the closing inventory of 6,000. So we've now posted in all of the transactions for the year. So let's take this a step further and let's see how we go about finalising the accounts, because we're asked for the gross profit. So how do we do that? How do we finalise the information that we have here? To finalise the accounts, we need to go through a couple of steps. Now we'll look at this in more detail later on, but I want to introduce it to you at this point because it's slightly different to what we did when we looked at creating the trial balance. So what we're going to start to do now is to separate out our income statement ledgers and our statement of financial position ledgers. So we need to know which is which. What we're going to do is we're going to clear out all of the income statement amounts to create an income statement ledger account. So we've already created the income statement ledger account because that's where we were posting our opening and closing inventory. But what we're going to do now is go through any of the accounts and ledgers that we've done so far that affect the income statement, like sales, like purchases. And rather than creating a balance brought forward on them, we're going to clear them out. And that will mean that the balance brought forward to next year is zero. So we're going to clear them out. That means that whatever balance is on them, let's say there's a balance of 10,000 on sales. Well, we're going to remove that 10,000 from sales and take it to the income statement ledger account. So that means that the balance brought forward next year will be zero. So let's see what I mean by doing that. Let's look at the income statement ledgers that we've done so far. So looking at our purchases, up to this point, we simply have the cash purchases in the year of 15,000. So the balance on that account is 15,000 on the debit side. What I'm saying is we're going to clear that out to the income statement by removing the 15,000. So credit 15,000 to the income statement. And that means that when we add it up, it comes to 15,000 on each side. There is no balance brought forward to next year. And that makes sense because our income statement records what's done in this year. It doesn't record what's done next year. So we want to clear out that balance on purchases so that when we start next year with it, we start afresh. We'll do the same for our sales. Up to this point, we had cash sales of 23,750. And what we'll do is we will clear that out to the income statement ledger account. So debit sales, credit the income statement ledger account. And that will mean that the balance on our sales account is zero. Now, what will that do to our sales? Now, what will that do to our income statement? So far in our income statement ledger account, we have opening inventory and closing inventory. We now need to deal with those purchases and sales. So we first of all cleared out our purchases. So we credited purchases and debited the income statement. We also then dealt with sales and we debited sales, credited the income statement account with the amount of sales. So we can see therefore that we have that amount coming into that income statement account. Now that's all of our income statement balances done. What we can do now is balance off this account and the balance will be the profit. So the income statement account here shows us what the profit is for the year. So the gross profit will be, when we add it up, 29,750 we get on each side. So that gives us a balancing figure of 9,750 for our gross profit. And that will be the amount that we bring forward on our retained earnings. So that will go to our reserves or our capital account. So what I'm saying here is that for all income statement accounts like our sales, our purchases, etc., anything that appears in the income statement, we clear it out at the year end into this income statement ledger. So that will enable us to calculate the profit for the year, because once we post in all of our sales and costs and we deal with our opening and closing inventory, we can balance it off and that will give us the profit. But what about our statement of financial position? Well, we've already cleared out our income statement. For our statement of financial position, we do exactly what we did last time. We close off the statement of financial position accounts to get the balance brought forward to next year's accounts. Because remember, statement of financial position will be carried forward into the next year. Our assets will keep getting bigger, for example, when we get new assets, etc. And the other balances in our statement of financial position will be the year-on-year balances. So we simply close those off and get us the amounts to bring forward to next year. Whereas the income statement, well, each year we want to clear it out to zero. So that means that the final accounts will show for the statement of financial position all the balances brought forward from the ledgers when we close them off. And for the income statement, the amounts shown in that new income statement ledger. We can simply take our amounts out of it. So let's do that to finish off our accounts here. So for our inventory, we had posted in these amounts. We simply now need to add it up to get 11,000, put that on each side, and the balancing figure on the credit side is 6,000. Well, we expected that because that was the closing inventory. So the balance brought forward down at the bottom will be the 6,000. So we balanced it off, carried forward with 6,000 on the credit side. Bring that forward over to the other side gives us an amount brought forward for our statement of financial position of 6,000, and that's the closing value on inventory that we expected. So that's what we would do for each of the statement of financial position balances. We don't need them because we only need to calculate the gross profit for this question, but we will come back to look at this in more detail when we do preparation of final accounts. I just wanted to introduce that concept at this point in time, that for the income statement, we clear out all of our income statement ledger accounts individually and bring them into one new income statement ledger. For our statement of financial position, we simply balance them off the way we did previously to get our brought forward figures. Now, once we've created that income statement ledger, remember this was it. We had all of our postings in there to get our gross profit. That gives us the amount that we were looking for, the gross profit for the year. Now, how does that appear in our final income statement? Well, we just put it into a different format. We just show this differently so that it's more understandable to the users. The format that we put it in is this. So we take the sales, we then show the cost of sales with the opening inventory plus the purchases less the closing inventory to get our gross profit of 9750. So it shows exactly the same thing. It just shows it in a more usable format for the users so that they don't have to interpret that ledger account. So that income statement ledger account forms the basis of the income statement that we present to the users. So now we know how to deal with our inventory. We also now know how to close off our accounts at the year end to get that income statement. Let's just finish this off by looking at some other areas that we need to be aware of on inventory. So now we know how to deal with our inventory in the ledger accounts. We also know how to deal with all of those income statement balances, that they will come in as a separate income statement ledger account. Just a couple of notes on inventory, things to learn, because they could well come up as little questions within the exam. For example, look out for drawings of inventory, i.e. inventory taken by a sole trader for their own use. So if inventory is taken by that sole trader and used themselves rather than being sold on, how do we deal with that? Well, what we do is we debit drawings with the cost of the item and we credit inventory with the cost of the item. So we don't recognize any profit on that inventory because we didn't make any. So we debit drawings with the cost of the item, credit inventory with the cost of the item. Do note that because you need to be able to deal with that should it come up, and it comes up quite regularly. Also then, other things we need to be aware of when it comes to inventory. One of the crucial aspects around inventory valuation is its impact on profit. And we already know that from looking at our AVCO and FIFO calculations, because a different valuation gives us a different profit. We saw that simply by valuing the inventory at a different amount, it had a big impact on our profit. So even though nothing else changed, our revenue stayed the same, our other costs stayed the same, the fact that the inventory valuation changed had an impact on our profit. So higher closing inventory will give us a higher profit because we subtract closing inventory out of cost of sales. So if our closing inventory is higher, our cost of sales is lower, so we get a higher profit. So if we have a higher closing inventory, we get a higher profit. Obviously then, if we have a lower closing inventory, we get a lower profit. And this is an area that we need to be aware of, because either through errors or manipulation, you could find that inventory could be overvalued. If inventory is overvalued, well then that will overstate the profit, because inventory is higher than it should be. If inventory was undervalued, well then that would understate the profit. And it has been known for accountants to manipulate the financial statements through deliberately overvaluing or undervaluing their inventory. So for example, they must choose between FIFO and AVCO when they decide what they're going to use to value the inventory. And they shouldn't just change between one and the other willy-nilly when they want to. There must be a valid reason for them changing between the two, and that would happen very rarely. So that would be an area that could be manipulated, and we need to be aware of it. So do be aware that errors can lead to an overvaluation of inventory that would overstate the profit. An undervaluation of inventory would understate the profit. When it comes to disclosures, also be aware that this will be done in a note to the accounts. So for our inventory in our financial statements, we need to have a note to the accounts that discloses the following things. It discloses the raw materials and consumables, so it shows the valuation of those. It shows work in progress. It shows the finished goods and the valuation methods used for each of them. So what I'm saying is that you need to split down the total value of your inventory into raw materials and consumables, work in progress and finished goods, and show those separately in a note to the accounts. You'll also need to show and disclose the valuation methods that you have used to value those items of inventory. So that was our session on inventory. Make sure you know how to value it at the lower of cost and net realizable value. Make sure that you know the difference between FIFO and AVCO and can do the valuation on that. And make sure you can post your ledgers for opening and closing inventory and close them off to get the correct answer, particularly to illustration 3. Also, do learn that those errors through overvaluation and undervaluation of inventory can have an impact and will have an impact on profit. So do attempt the test your knowledge questions at the end of the chapter. If you're not quite sure of anything, go back over it and reattempt all of the illustrations that we did here today.